Hey, how's it going? Bill Lethman here for Money Evolution. In today's video, we're going to be having a good old-fashioned showdown between bonds or traditional fixed income investments versus an annuity. So if you're somebody that's getting closer to retirement, or maybe you're already in retirement and you're starting to think a little bit more about transitioning some of your more risky growth investments away from those more volatile types of investments and moving it into something a little bit more conservative, then I think you're going to get a lot of value out of today's video. This could be because maybe you're trying to build out your bucket strategy and trying to figure out how you're going to go into that next phase of your retirement, the distribution phase, or maybe you're just trying to get a little bit more closely aligned with that traditional 60-40 model that you hear a lot of people talking about. But real quick, before I get into the content of today's video, if you want to learn more about what we do at Money Evolution, you can head over to our website, moneyevolution.com. There you can learn about our financial planning programs that we have, the Retirement Time Machine and the Money Evolution Plan. We've also got a lot of really great free resources available. And by the way, we'll put links to all of that stuff down in the description below. Okay, so when we think about having a little bit more of our portfolio in some of those more conservative investments, there's really a couple things that we want those investments to do. One of those is we want those investments to generally be a little bit more on the safe side. We want those investments to not lose a lot of money if the market goes against us or we go into a bad cycle. And we really want to have something that's going to be kind of a balance to some of those growth investments that we're going to have likely in growth type of mutual funds or ETFs or index funds or whatever that may be depending on your situation. So number one, we want that to be safe. And number two, because we're going into that next phase of our life where we're going to start to have the distribution phase or the withdrawal phase of our retirement, we want that to hopefully pay some income or some type of a withdrawal benefit or dividend or something along those lines. That's really our main purpose for that. Now, here in 2025, we're filming this, I think it's May right now, depending on when you're watching the video. Interest rates are still pretty good right now. In fact, actually, as we stand today, the 10-year Treasury is still right around 4.3%. That's bounced around a little bit here. It may be higher or lower by the time you watch this video, but we're going to assume for purposes of today's video that the 10-year Treasury yield is 4.3%. CD rates are still pretty decent depending on what maturity that you want to get. You're still maybe around 4%. That's maybe at the little bit shorter end of the yield curve there. We still have a little bit of inversion there on a lot of these fixed income markets. And what that means is that the interest that you're getting on the shorter end of the yield curve is higher in many cases than it is on the longer end. So that's something kind of unique about today's situation. And we're going to go in and just basically take a deep dive on this. We're going to go through a little bit of math here in the video and really get into some of the numbers so you can understand how both of these different types of investments work. And even if you're just thinking about the fixed income portion, you're going to understand the mechanics of how to set up that fixed income portfolio for income over the long term. So let's jump into some of the numbers here. The first thing we're going to do is we're going to talk about the fixed income. Fixed income is just another name for bonds here. The reason it's called fixed income is because the issuer of whoever issued that bond or CD, they're going to agree to pay you a preset amount of interest for a predetermined period of time. So for example, if you bought a 1-year CD and it was paying 4%, you're going to get that 4% for that 1-year period that you're going to essentially have that money locked up into that investment. If it's a 5-year bond that we're talking about and it's paying 4%, it's going to pay you that 4% over that 5 years, and then at the end you're going to get your original investment back and have to go back and reinvest that into something else. So let's talk a little bit about how bond prices move, and this is something I've talked about in other videos. Maybe you know this, it's a little bit of a refresher here, but essentially bond prices or fixed income prices are going to be inversely related to what interest rates do. So if you buy a CD or if you buy a bond, you can absolutely hold that to maturity, and if you do, you're going to get your principal back at the end and all of the interest that they've agreed to pay you along the way. Sometimes all of the interest is paid at the end of that. It's called a zero coupon bond or investment where you get all of the interest at the end. But basically, in the meantime, though, if you wanted to get out of that investment, even a CD, at least the ones that we have, they have secondary markets for CDs where you can buy a 2-year CD and sell it after 1 year. Now, when you do that, the price of that investment is going to change a little bit based on where interest rates are going. And that's going to be the same thing for a bond. You can buy a 5-year bond or a 10-year bond or even a 30-year bond, and you can sell that at any point along the way because there's a very active secondary market in all of these different fixed income investments here. But basically, the prices are going to change based off of what the prevailing interest rate environment is doing. And so we're going to say that rates are inversely related to value, or value is inversely related to rates. So if rates were to go up, the value of that particular bond or CD is going to go down a little bit in value, or it could be a lot depending on a couple of factors, which I'll explain here in a second. If rates were to go down, the value of that is going to go up, generally speaking here. And the reason for that is, let's say that today you bought a bond that was paying 4%. Let's say it was a 5-year bond, and a couple years goes by and you want to get out of that bond. Well, your bond is paying you 4% right now, and maybe let's say there's 3 years left to maturity. So you would basically evaluate that bond compared to other 3-year bonds. It was a 5-year bond originally, but now it's a 3-year bond because there's essentially 3 years left. So if interest rates have gone up a little bit and now new bonds are paying 5% instead of 4%, well, you're going to really have a hard time selling a bond that's paying 4% when new 3-year bonds are paying 5%. So what do you have to do? Well, you can sell anything, you just have to have the right price. So in order to sell that bond that's paying 4%, that has 3 years left, you're going to have to lower the price. It's going to have to be a discount is what that's called. And there's somebody out there that would buy that bond and then hold it to maturity. So they would get a little bit, they would still get the same amount of interest, they'd still get that 4% interest, but they would be paying a little bit less for that bond, but it's going to mature for the full value. And the opposite is also true. So if rates were to go down, your 4-year or your 5-year bond that's paying 4%, if the rates went down to 3%, and after a couple of years you wanted to sell that, you could absolutely do that, but you would be foolish to sell that for the face value or what you paid for that. You would want to increase that or charge a premium on that particular bond or CD or whatever it happens to be, because the prevailing interest rates have gone down from 4% to 3%. So they would overpay for that, and then they would get a little bit less than what they paid back at maturity, because it's always going to just pay whatever that face value is, if that's, let's say, $1,000 or whatever that happens to be. So let's talk a little bit about where kind of the history of interest rates have gone. So we know a little bit now about how the bond prices or fixed income prices are going to move a little bit depending on where interest rates are. And so when you invest in a single bond or a single CD, it's really a lot more simple. There's what we call permanence and definition with that. We know what we're paying for that, we know what it's going to mature for, and we know what interest we're going to get along the way. But when we buy into, let's say, an ETF or a bond mutual fund, it's going to be a collection of a whole bunch of different bonds or fixed income securities, and they all are going to have some unique individual characteristics with each one of those different bonds. So we really, if we go into those types of packaged investments, let's say, you really want to have an understanding of what is in that particular portfolio. So if we go back and we look at what's happened in the bond world or the fixed income market over the last 40 or 50 years, we know that right around the early 80s here, like 1981, 1982, interest rates peaked. And I think at the highest point, the 10-year Treasury was paying about 14% interest. If you remember back in those times, we have a lot of clients that talk about their first mortgage that they got that was a double-digit mortgage rate on their first house that they ever bought. And really since 1981 all the way through really about 2020 really was when I think the bond market really fell to its lowest level. The 10-year Treasury in 2020 and the COVID crisis, I think, fell down to about 0.89%, something less than 1% on that. And so essentially, if you owned any kind of bonds or bond mutual fund and things, you were basically doing two things. You were getting a coupon along the way, and most of that period of time had some pretty decent interest rates, although since the great financial crisis in 2008, 2009, yields were really pretty low during most of that period, about 3% or so, if we're talking about the 10-year Treasury. but you're getting some pretty decent yield, but you're also being able to do something called riding the yield curve. So part of the total return of a lot of those bond mutual funds, especially if you look back over longer track records, is going to consist not just of that interest payment or the income that those bonds were paying, but also some capital appreciation. In fact, in many cases, the capital appreciation on that portfolio was really pretty decent, maybe even making up 20, 30, 40, even 50% of the total return of that particular fund. And where we stand right now with interest rates at 4%, again, they're up a little bit from what they were, obviously, at the worst part of the COVID crisis there. But the real question that we have to ask ourselves is, what are interest rates going to do going forward? And the bottom line is we just don't know. Interest rates could go up a little bit, they could go down a bunch. One thing I would say is that with having this massive debt that our federal government has, the $36 trillion, there is, I think, an incentive for the government to want to get these interest rates down. And I think overall, having a little bit lower interest rate environment is a good thing. It's probably not a good thing for people that are in retirement needing that for income, but it is good for keeping the overall growth of the economy high. People can buy houses and cars at lower borrowing cost, for example, and really keep that economy going. So having a lower interest rate, I think, is a good thing overall long-term for the economy, but we just don't know where interest rates are going. So let's run through just a little bit of a hypothetical example here. We're going to carry this over when we start talking about the annuity as well, but we talk about the 4% rule in a lot of videos where if you limit your withdrawals to 4% or less in any given year, you've got a pretty good chance that money's going to last you for the rest of your lifetime. That was done in the early 90s by a financial planner named William Bengen, and he did it based off of a 20-year retirement, because I think that life expectancies were a little bit lower back then, and people tended to retire a little bit later there. So that made sense. Now, with people retiring earlier, you may be hopefully one of those people that's retiring early, and really having that really last you for maybe 30 or 40 years in some cases, depending on your longevity and history that you have in your family. So continuing on with our 4% rule of thumb here, let's say that you, just to keep our math simple, let's say that you need $40,000 a year of income for your retirement. And this could be all of the income that you need, or this could just be one component of it. Maybe it's to cover and supplement some of your Social Security and pension income just to cover your basic expenses. But let's say you need $40,000. Well, if interest rates right now, let's call it about 4% to make our math even easier, you would need then about $1 million in a fixed income investment to get you that $40,000 per year. Now, if you put it all into the 10-year treasury, let's say, maybe it's going to be a little bit less than that, or if you put it all into the $1 million into a 10-year treasury, it's going to actually pay about $43,000 a year over that period of time. And that's very consistent. It's very determined what we are going to get out of that. If we put $1 million into a 10-year treasury and we just collect the interest along the way, we know we're going to get $43,000 a year. Now, in between now and 10 years from now, the value or the price that we're going to see on our statement for that treasury is going to go up and down depending on what interest rates do. Just like we talked about with that teeter-totter, essentially, with rates going up, the price or value of that bond is going to go down a little bit, and if rates were to go down, the value of the bond would go up a little bit there. But if we held it to maturity, you're going to get that $43,000, and you're also going to get your $1 million back at the end of the 10-year period. And at the end of 10-year period, what is going to happen? Well, we don't know what's going to happen. It's going to depend on what interest rates are at that time 10 years from now, and we have absolutely no way of knowing what interest rates are going to be 10 years from now. We know one thing is that it can only be one of three possibilities. We can either have interest rates be the same, and if it is the same, then we can take our $1 million and we can reinvest it back into another 10-year treasury or whatever other fixed income we want, and we can get that same $43,000 a year for another 10 years and do the same thing and repeat the process. Rates could be higher, which would be a great thing. And so if rates were to go up to 5% on that 10-year treasury, well, instead of getting, let's say, $43,000 a year, we might get $50,000 a year off of that bond investment. And again, we're still going to get our $1 million back at the end of the next 10 years, which would actually put us 20 years out into retirement. The third option is the one that we really don't want, and that's interest rates are lower. So what happens if interest rates went from 4%, let's say, down to 2%? Well, then instead of getting $43,000 a year, if it was only paying 2%, then our income would only be $20,000. And I think for most people, that's not a scenario that you really want to have happen, obviously. You don't want to have to, halfway through your retirement or 10 years into retirement, all of a sudden change your lifestyle and say, I was living off of $40,000 a year, now I'm going to have to change that to $20,000. Now there's a lot of other strategies, and we talk about the bucket strategy and having part of your money in a balance between a growth bucket, kind of a medium-term bucket that might be CDs or some fixed income, and a cash flow bucket that's for the 1 or 2 years of the next couple of interest or income payments that you need for your retirement expenses and things. So a bucket strategy would be something, but that's constant movement. You constantly have to be selling off part of the growth bucket to refill buckets 1 and 2. I've made a whole other video about just that exact thing. So if you're looking for something that's going to be a little bit more consistent, something that you can just kind of rely on, this is the scenario for a typical fixed income investment. Now again, it's going to be maybe another 10 years that you're going to have to go in there. So if you retire at 60, you get your first bond maturing at age 70, and then you have another bond that's going to take you through age 80. Hopefully you're still going to be alive and doing pretty well. You might have to do it 1 or 2 more times even if you make it into your 90s, or maybe there's a little bit of an age difference between you and your spouse. So now there's a lot of other strategies that you can do to try to build up this income. One of the things that I've talked about in other videos, many other people do as well, is utilizing something like the bucket strategy. And essentially what that is to keep cash flow buckets 1 and 2 with more of your safer or conservative investments, generally having about 2 years of cash flow needs in bucket number 1, maybe another 5 years of cash flow needs in bucket number 2, and then the rest of that could be in the growth bucket. And this is something that I think can work fairly well. There is no guarantee about how it's going to work. I made a video here not too long ago that was titled, I think, How One Flat Market Could Destroy Your Bucket Strategy. And essentially, we just don't know what the financial markets are going to do. There's been a lot of good times here over the last decade and a half or so, with maybe a couple little blips along the way, very quick market recoveries, and that could lend itself to a bucket strategy working out very well for you. But in the past, there's actually been many other periods of the market, in terms of the stock market anyway, where there's been a lot of sideways markets or bigger crashes that take a longer time to recover from. But essentially that bucket strategy could take the same $1 million, you could split it up into these 3 different buckets, have some safer investments in buckets 1 and 2, basically use this for your retirement withdrawals, and then every year, or at least as long as the markets are up, you're going to take money from the growth bucket and you're going to come back and refill buckets number 1 and bucket number 2. The idea being with this bucket strategy is that if the market does go through a downturn or through a flat market period, you're going to let buckets 1 and 2 sort of drift down. Hopefully they don't get all the way to 0 before the market finally recovers back up to the top, but you're going to basically let that give yourself a little bit of a buffer there with that bucket strategy. Okay, so now let's jump in and let's look at an annuity and let's see how that compares to what we just went through with that fixed income option. Let's say buying that 10-year treasury as an example here. So one of the things about an annuity is annuities are actually designed to pay a guaranteed income or a guaranteed withdrawal, usually for the rest of your life. And if you're married, you can usually tie that into your spouse's lifetime as well. So that income is going to continue for the longer of either your life or your spouse's lifetime. Now, up here on the board, we're filming this in May of 2025 again, so rates are subject to change. But here's some rates from one of our annuities that we work with clients on. We have a 60-year-old. If you're single, the guaranteed lifetime withdrawal benefit for this annuity would be 6.6% per year. And again, that's going to be guaranteed as long as you are alive. If you're doing a joint income, typically we're going to see that maybe reduced by about 0.5% on most of these annuity contracts, but that would drop to 6.1%. So we think about that and just compare that right off the bat to, let's say, the 4.3% that we were talking about in fixed income. This is certainly going to give you more cash flow throughout the rest of your lifetime, but we're going to talk about some of the advantages and disadvantages of this maybe versus that other fixed income option. If you're 65, those rates are going to be a little bit higher. Generally, the older you are when you buy your your annuity contract, you're going to get a little bit more of that income. And that's just because it makes sense. Like delaying your Social Security benefit, the longer you wait to begin collecting is going to be less years that the annuity company or Social Security, whoever, is going to have to pay those benefits out there. So a single at age 65 would be 7.3%, and a joint would be 6.8% there. So again, still very good rates. You get a little bit more by waiting here. Okay, so now let's add a couple numbers to this. So what we're going to be focusing on here is we're going to be looking at the joint income. We're going to do it for age 60 and again for age 65. So if we were to compare this to what we just did with the fixed income, let's say that you can get that $43,000 a year of income from a 10-year treasury. Again, that rate today in May of 2025 is about 4.3%, so we'll go with that. And the way we would do this, so we could say, okay, how much money would we have to put into an annuity and get that same $43,000? Well, if we took the joint, I'm going to put this in red here. If we took the joint income of 6.1%, we would divide this out by 0.061, and I did that math already, and it is $704,918. And so effectively, we're able to be, I think, a lot more efficient with this money and basically taking not all of the $1 million that we did to get the $43,000, but just put in $704,918. So basically, let's round it up to $705,000, and we're basically getting the same amount of income. Now, the big difference here, of course, is that this is guaranteed, that $43,000 a year is guaranteed for the rest of your lifetime and your spouse's lifetime if they're alive. We don't have to worry about what that new interest rate is going to be 10 years from now when that 10-year treasury matures. It could be higher or lower, but we don't want it to be lower. And even if it's the same, this annuity is going to continue to pay that out. We're going to talk about, I know what some of you may be thinking there, but yes, but with the 10-year treasury, I still always have my $1 million. And that is absolutely true, and I'm going to get into that in just a minute here. If we did the same thing and we looked at the 65-year-old, of course, we're getting a higher rate of income or withdrawal on that. So that is going to, if we do the same math there, that's going to be $632,000. And I'm just going to round that off there. It's a little bit over that, but $632,000. So a little bit over half of the portfolio to put into this annuity, and you're getting the same amount of income at that age 65 that you would by putting that money into a 10-year treasury. Okay, so one of the big differences of what we're talking about here on this annuity versus what we did in our fixed income scenario, at least the way we ran it, is that you still retain that $1 million principal investment. So it paid out the $43,000 a year for the first 10 years, and hopefully, let's say interest rates stay the same. Let's give it the benefit of the doubt. Let's say you can continue to get that $43,000 a year. Interest rates stay steady at 4.3% for the rest of your lifetime. Well, you'll still have $1 million in that scenario for the fixed income. Whereas on the annuity, in all likelihood, at least the way we would anticipate this, the annuity eventually is going to run to zero because that guaranteed withdrawal rate is guaranteed. However, it's going to be withdrawn from the value of your portfolio. And I'm not going to get into all the details about how annuities work. I just did make a video on how a fixed index annuity works, which is what we're talking about here. But essentially, a couple things are going to be happening within this fixed index annuity. One is that you are always going to be guaranteed to at least get back your original principal. So if you put in the $632,000 or the $705,000 into the annuity and you start receiving payments, if you died before you got back your original $705,000, let's say, you're going to get the remaining part of that as a death benefit. And again, if your spouse is part of that, you're doing joint income, you're going to be able to have your spouse continue to get that. But let's say you both pass away, you're always going to be guaranteed to get back your original principal. But because these withdrawal rates are very good right now, in my opinion, there's a good likelihood that that's going to eventually exhaust the value of your annuity, and it's going to go to zero at some point. It might be 10 years down the road, it might be 15 years. It's going to depend on a couple of factors there. And again, if you want to learn more about that, check out my fixed index annuity video where you can learn more about that. So even though you don't have the $1 million left over at the end of the annuity scenario like you did when we talked about the fixed income option, you don't actually have to put the full $1 million into the annuity to get that same $43,000 of income for the rest of your life. So it's going to depend, of course, on whether you're single or you're doing a joint life and what your age is. But if we look up here, and out of all these numbers that we have, the one that would probably show the least favorable for the annuity would be a joint income and a 60-year-old on here. And we determined earlier that it would take $704,000, or let's just round it up to $705,000 to put in the annuity to get that guaranteed $43,000 a year for the rest of your lifetime, which means there's going to be a little bit of money left over. In this case, it's going to be $295,000 that's going to be left over and doesn't have to go into the annuity to get that same income that we compared to on the fixed income side. So this can be invested in something, and it can be invested however you want. You can put it in something growthy, something a little bit more balanced or conservative, but let's just assume that you earn a 7% rate of return, which I think is reasonable for a balanced type of a portfolio. This is going to grow over time. And let's say over 10 years, if you got that 7% rate of return, that's going to grow, I've got the numbers down here, to about $580,000. And I'm just going to round these numbers off a little bit. So it didn't quite make up all of the ground from the $1 million. Depending on how the annuity did, there may still be a little bit of money left over in the annuity. Let's assume it just went to zero in the first 10 years, which may or may not happen depending on that. But again, you're going to have this other bucket that can grow. And if you think about it, your two phases of investing that you've been through in your life, or you will be going through in your lifetime, the accumulation phase and the withdrawal phase. And one of the things, there's actually two things that made you successful, I think, or probably made you successful or led to your success in the accumulation phase, and that is, one is that you weren't taking any money out of the portfolio, so you got to be a long-term investor. You got to ride through the ups and downs and rely on the long-term market averages, which tend to be very good over long periods of time. In the short run, they can be quite volatile. You can go through sideways periods or very negative periods in the market, but over a long run, you tend to get more consistent returns over longer periods of time. And the second piece of that is that you were adding money to those portfolios likely and building that up. So you were actually buying more shares when the market was down and everything. So one of the things that you're kind of shifting gears a little bit, flipping the script, I guess, on the type of investor you are. So with this money that is left over, this $295,000, you can once again become a little bit of a long-term investor, and you can ride through those market ups and downs, as opposed to like a bucket strategy where you're constantly having to be on top of what is the market doing? Is it up? Is it down? How long is it going to be down for? Should I take some of that money out, refill bucket one and bucket number two? You don't have to do that. You could just simply let this money grow, and if it grows to an amount that you want to take a little bit of a withdrawal to supplement some other retirement savings, you're going to be able to do that and have that money available as another source that you can get some additional money. Now, you probably, if we're talking about this $1 billion fixed income versus the annuity, generally that's probably not going to be all of the money that you have. It's going to be a part of it, but we're just isolating that $1 million to compare how that looks on an annuity versus this fixed income option. So you have $580,000. And again, the power of compounding. So after 20 years, that's going to grow to $1,184,000. And you've now surpassed the amount that was left over in that annuity, that $1 million. In fact, the actual break even for this is 18 years, where the money that you had, that $295,000 that was left over, grew to the $1 million to basically match what would hypothetically be left over in that fixed income bucket. And if we go out one more decade and we say 30 years, and again, it's joint income for you and your spouse, 30 years would not be unreasonable to have at least one of you or your spouse making it to age 90, and that doubles over that period of time to $2.245 million at the end of 30 years. Now you have actually twice as much money left over in this as you did with the fixed income option there. So I hope that makes sense. I'm going to run through one more quick scenario, and that is a delay of turning on the income for the annuity. So we talked about with an annuity, every year that you are older, when you buy the annuity, you're generally going to see a little bit of a tick up in that rate, usually about, we see about 10 basis points or 1/10%. So if you, in these examples up here, we're looking at 6.1%. Generally, you're going to see that maybe at 6.2, 6.3% if you waited one more year to take to buy the annuity, actually. Okay, but if you buy the annuity and you delay, there's also going to be an increase in that withdrawal rate. So on this same annuity, if you were 60, we know that your starting withdrawal rate for joint income would be 6.1%, but that withdrawal rate is going to go up by 0.55%, a little bit over 0.5% per year. So if you were to delay to age 65, so you have 5 years of delay, that would give you an additional 2.75% added to the withdrawal rate. So instead of getting 6.1, you're actually going to get 8.85. And you're still going to be relatively young in terms of retirement, 65 years old, and again, maybe making it to 90, 95 years old, whatever that may be. But if we do that math backwards and we say we want to get that same $43,000 a year of income, now instead of having to put in, let's say $700,000, $705,000, you could do $485,875. Whoops. So now just half of that can be put into the annuity to get the same amount of income. Now, in all fairness, if we went back and compared that to the fixed income option, you would have some money that would be put into the 10-year treasury, let's say, and it's going to make that 4.3% for the first 5 years. So maybe you don't have to put all of the $1 million in. Maybe you'd have a little bit of money left over there, but it's still going to be pretty significantly less than what this is. So in my opinion, this is definitely something to at least take a look at and run the numbers for your individual scenario, see how it all kind of shakes out. What are the guaranteed withdrawal rates, and how does that fit into the overall long-term retirement cash flow planning strategy for you? So I know this was a little bit longer video. We got into some real weeds here on the numbers and the nuts and bolts of how these things work. Again, if you want to learn more about how a fixed indexed annuity works, we've got a link down in the description below to the video that I did recently on that. And if you want to learn more about what we do at Money Evolution, check out some of the links down in the description below. And thank you for watching. I'll see you in one of my next videos.